Let's dive JustProfessor here. You just got a $100 tax refund and you spend it on something fun without thinking twice. But you would never take $100 from your savings account to buy that same thing. It's the same money, same amount, same value. So why does it feel completely different? Your brain doesn't treat all money equally, even though every dollar has the same value. You put money into different mental categories based on where it came from, or what you plan to use it for. Money in one mental account feels different from money in another mental account, even when they're literally the same thing. This is called mental accounting, and it's making you waste money, miss opportunities, and make financial decisions that make no logical sense. Mental accounting is when you treat money differently based on arbitrary categories you've created in your mind. You might have mental accounts for savings, spending, bills, fun money, gift money, or bonus money. Each account has different rules. You're careful with money in one account, but careless with money in another. You feel good spending from certain accounts, but guilty spending from others. None of this matches economic reality where money is money, regardless of which mental bucket you put it in. This happens because your brain likes categories and rules. It's easier to manage money when you can put it in boxes and follow different rules for each box. But those boxes are artificial. They don't reflect actual financial reality. $1 in your fun money account has the same purchasing power as $1 in your savings account. But it doesn't feel that way, so you make different decisions with identical resources. The problem is, mental accounting causes you to make choices you would never make if you thought about money rationally. You waste money from certain accounts that you would carefully protect if it was in a different account. You avoid smart financial moves because they require moving money between mental accounts in ways that feel wrong, even though they're perfectly logical. Your made-up categories are controlling your real financial outcomes. Let me show you how mental accounting creates bad financial decisions in everyday situations. Tax refunds and bonuses get treated as free money, even though they're not. You worked for that money. It's your money. But because it arrives as a lump sum separate from your regular paycheck, your brain puts it in a different mental account. You feel free to spend it on things you would never buy with your regular salary money. You blow a $1,000 bonus on something unnecessary, but you carefully budget your regular paycheck. It makes no sense, but it feels different. This is why people often have credit card debt while also having savings. Logically, if you have $1,000 in savings earning 2% interest while you have $1,000 of credit card debt charging 20% interest, you should use the savings to pay off the debt. You'd save a ton of money. But people don't do this because the savings account and the credit card exist in different mental accounts. Savings feels sacred and protected. Debt feels separate. Breaking into savings to pay debt feels wrong, even though it's the smartest financial move possible. Gift money gets treated completely differently than earned money. Someone gives you $50 as a gift. You spend it quickly on something indulgent, but you would never take $50 from your bank account to buy that same thing. The gift money felt like bonus money that didn't count, so spending it didn't feel like real spending. Your brain put gift money in a different mental account with looser rules. Gambling winnings create extreme mental accounting. You go to a casino with $100. You win $200. Now you're playing with $300 total. But in your mind, the $200 you won isn't your money yet. It's house money. So you make risky bets with it that you would never make with the original $100. You end up losing everything. If you treated all $300 as equally yours, you would have been more careful and probably left with some winnings. Coupons and sales manipulate mental accounting. You use a coupon to save $10 on groceries. That $10 feels like free money now, so you spend it on something else at the store. You didn't actually save money. You just moved it from one purchase to another. But mental accounting made the saved money feel different from your regular money, so spending it felt fine. The same thing happens with sales. You buy a shirt on sale for $30 instead of $50. You saved $20, right? So you buy another item for $20 because you saved that money anyway. But you didn't save anything. You spent $50 total, which is what you would have spent on just the shirt at full price. Mental accounting about saved money made you spend more. Expense categories create weird decisions. You set a monthly budget of $100 for dining out and $50 for entertainment. One month you want to see a concert that costs $70. You don't have $70 in your entertainment budget, but you have plenty left in your dining budget. Logically, you could just use some dining money for the concert. It's all your money. But mental accounting makes you feel like you can't afford the concert because the entertainment account is short, even though your total available money is more than enough. Windfall money gets wasted because it exists in a special mental account. You inherit $5,000. You wouldn't normally spend $5,000 on a vacation, but this is inheritance money, not earned money, so it feels okay to splurge. Your brain categorized it as special money with different rules. You spend it differently than you would spend $5,000 that came from working, even though it has the same value. Credit cards create mental accounting separation from real money. Paying with a credit card doesn't feel like spending real money in the moment. The money comes from a credit account in your mind, not your bank account, even though you'll have to pay it from your bank account eventually. This separation makes people spend more on credit cards than they would spend if they paid cash for the same items. The mental account for credit feels different from the mental account for cash. Retirement accounts get treated as untouchable even when using them makes sense. Someone has a financial emergency. They have money in a retirement account, but they take out a high-interest loan instead of withdrawing from retirement. They'll pay way more in loan interest than they would lose by temporarily using retirement funds. But retirement money exists in a protected mental account that feels wrong to touch even when it's financially smarter to use it. Investment money follows different rules than savings money in people's minds. You have $10,000 invested in stocks. The investment loses $2,000 in value. You feel bad, but you don't panic. But if someone stole $2,000 from your savings account, you'd be devastated. It's the same loss of $2,000. But investment losses exist in a mental account where losses are expected and acceptable, while savings losses feel catastrophic. So, how do you stop mental accounting from ruining your financial decisions? How do you treat money rationally when your brain keeps putting it in different mental boxes? First, recognize that all your money is your money. It doesn't matter if it came from working, gifts, refunds, bonuses, or inheritance. Every dollar has the same value and the same opportunity cost. When you're about to spend money from your fun account that you would not spend from your savings account, stop and realize you're being irrational. Second, think about financial decisions in terms of total wealth, not individual accounts. When deciding whether to buy something, don't ask if you have enough in the mental account you assigned to that category. Ask if spending that money is the best use of your total available resources. This removes the artificial constraints of mental accounting. Third, be willing to move money between mental accounts when it makes financial sense. If paying off high-interest debt requires breaking into savings, do it. If a good opportunity requires using money you had mentally assigned elsewhere, adjust. Your mental categories should serve you, not control you. Fourth, treat windfall money the same as earned money. Before spending a tax refund or bonus differently than your regular income, ask yourself if you would make the same purchase with your regular paycheck. If not, recognize that mental accounting is pushing you toward wasteful spending. Fifth, calculate the actual financial impact of decisions across all accounts. When you're keeping savings while carrying debt, calculate how much the mental separation is costing you. Seeing the real numbers helps override the emotional feeling that different accounts should follow different rules. Sixth, use mental accounting strategically instead of unconsciously. If you want to save money, automatically move some into a mental account you protect carefully. That's fine. But be aware you're using a mental trick and be willing to override it when the trick stops serving your actual goals. Mental accounting is making you treat identical money differently based on made-up categories in your head. You waste money from accounts that feel less important. You make terrible financial decisions because moving money between mental categories feels wrong even when it's smart. You think you're being organized and careful, but you're actually being irrational and costing yourself money. This happens because your brain prefers simple rules and categories to complex, rational analysis. It's easier to have a fun money account you can spend freely and a savings account you protect carefully than to constantly calculate the optimal use of all your resources. But that simplicity comes at a cost. The mental categories don't match financial reality, so following their rules leads to bad outcomes. The real problem is mental accounting feels right. Treating bonus money differently than salary money feels natural. Protecting savings while carrying debt feels responsible. Spending gift money on treats feels appropriate. Your gut tells you these are good decisions because they follow the rules of your mental accounting system. But your gut is wrong. These decisions only make sense within the artificial framework of mental accounting, not in actual financial reality. Understanding mental accounting doesn't mean you have to treat all money identically. You can still budget and organize your finances. But you need to recognize when mental accounting is pushing you toward irrational choices. When the mental categories tell you to do something that doesn't make financial sense, override them. The next time you're about to spend money differently because it came from a different source or sits in a different mental account, pause and ask if you would make the same decision if all your money was in one account. If not, you're letting mental accounting control you. Every dollar you have is equally yours and equally valuable, regardless of which mental box you've put it in. Subscribe to discover more ways your brain tricks you into bad financial choices.